Hey, welcome back to YT Finance, and this is the channel where I went to business school so you didn't need to, and today we are talking about Rivian stock, UiPath, as well as Velo3d. In this video, we will be analyzing their latest news updates, price targets, and whether or not I like or dislike any of these companies. We'll be starting off analyzing an article titled, Why Rivian Stock is Riding Higher Today, and as you know, Rivian is an electric vehicle company that is most known for their electric vehicle pickup trucks. Next, let's move on to UiPath, who is potentially becoming the next Salesforce, although this article is rather bearish in my overall opinion. And then lastly, we will round out the video talking about Velo3d, which is a 3D printing company also known as an additive manufacturing company. So with that being said, I would love for you to go and annihilate that like button right now for more videos just like this, because it encourages me to do some stocks that may be under the radar for some people, so I can at least give you some exposure to these other companies. Even though these are not buy or sell recommendations for these companies, it is just pure information. Whether or not you buy or sell is going to be completely up to you, your risk tolerance, your strategy, and any other variable that you have for your portfolio. But don't forget to go and like the video, subscribe if you are new, don't forget to become a member of this channel for as little as 99 cents to support me personally, and without further ado, I say let's jump right into today's stories. Rivian, ticker symbol RIVN, is powering higher today due to recent analysts responding very positively and bullishly on the news surrounding electric pickup trucks. On top of that, Rivian is also getting an increase due to what Ford has said recently, where Ford came out and said that the electric vehicle demand is still very high. However, the prices are too inflated right now, so when prices come back down, we're going to see a surge in demand for these types of products. Right now, Rivian, ticker symbol RIVN, trades for around $26.94, while very bearish analysts believe this company is going to fall back down to around $14, and more bullish analysts believe the company is worth around $40. So honestly, right now, it's hovering at a sweet spot of what the company should be worth in my overall opinion. However, multiple financial institutions have increased their price targets on Rivian as of right now. For instance, a Needham analyst actually increased their price target from $28 up to $31, which gave Rivian stock a small boost, meaning that there is around 19% upside left in this overall company. On top of that, we have Tigress Financial, who also recognizes that Rivian could be undervalued right now, and they raised their price target up to $36 per share. They believe as the company increases production that their deliveries will increase, and if they pair that with growing efficiencies of their production plants and manufacturing processes, that's going to drive significant revenue growth and set them on a path toward profitability, which is very positive. On top of that, the author of the article wants to make sure that you at least have Rivian on a watch list, because he says that there are other valid reasons why electric vehicle investors should look further into Rivian stock. He also says that investors need to pay attention on what the company has to say in their upcoming second quarter financial results, which are going to be released on August 8th, so feel free to keep an eye out for that. So I at least wanted to do a quick update on Rivian stock, make sure that it's still on your radar so you all can view it, and I would love to hear your thoughts and opinions down below on it. With that being said, let's move on to the next story that we have, which is UiPath, ticker symbol PATH, ticker name Path. And if you don't know what this company is, don't worry. This company essentially develops software robots that can be used in conjunction with other software applications to automate repetitive tasks, such as entering data, processing invoices, onboarding customers, and sending out mass emails. So essentially, it takes repetitive tasks and makes them far more efficient to where a person doesn't have to do these tasks, and instead a robot can just do them extremely efficiently. And therefore, the consequence of this is that these robots are technically replacing human employees, thus saving the company a lot of money. However, some people don't like this, how artificial intelligence is replacing human workers. So depending on what you think about that, that could impact how you see the company. Now, the good news is that according to Gartner, UiPath controls around 34% of the global RPA market. And RPA just essentially means robotic process automation. And UiPath is a leader in this because, again, they are automating very repetitive tasks that organizations and companies do every single day. And lately, UiPath has been expanding on their share of the overall market, while smaller rivals are actually losing market share, meaning that UI is a dominant player in this space. Right now, ticker symbol PATH, ticker name Path, is trading at around $17.43 cents per share, while negative bearish analysts believe the company is going to fall down to around $12, while more bullish analysts believe this company could go as high as $25 over the next 12 months. But for me, let's look at their financials. From fiscal 2020 to 2023, we saw UiPath's revenue increase by a compounding annual growth rate of 47%. And like I've said in previous videos, if you can identify a company that is growing at a CAGR of 30% or above, this means you have identified an extremely rapidly growing company in regards to the revenue. This allowed them to bring in $336 million and then transform that into $1 billion in just a 3 to 4 year time frame. However, with that being said, analysts do anticipate that UiPath's revenue will actually decrease to around a CAGR of 19% going forward from 2023 to 2026. But even 19% is not that bad. And they think this is going to happen due to the tougher macroeconomic environment as well as competitive headwinds. And for me, I would keep an eye out for their overall competition. They have huge competitors such as Salesforce's MuleSoft RPA, Microsoft's Power Automated RPA, and Appian's RPA. So these are three major technology companies that also offer RPA, which, like we said earlier, stands for robotic processing automation or robotic process automation. So it's not like UiPath is the only one that can do this. But for me, I would say that if the entire market is only divided between 4 large companies such as UiPath, Salesforce, Appian, and Microsoft, clearly there is still room for UiPath to grow. However, to make things worse, UiPath is not profitable as of right now, and analysts expect them to bring in a loss of around $100 million to $200 million every year annually from now until 2026. So it's not like this company is going to become profitable anytime soon, according to current forecasts. So this company is really a gamble. However, I do know that a lot of people tend to like this overall company. I know Kathy Wood of ARK Invest has bought this company multiple times, and some investors really like the future potential of this overall company. However, it really depends on how long you are planning on holding this overall company, because like we said, they're not anticipated to become profitable until 2026 unless they get a huge revenue boost. So I just wanted to put that on your radar. And then lastly, let's talk about a 3D printing company named Velo3d, which is an additive manufacturer. Velo3d is an under-the-radar company trading right now for only $2.07, and they're up almost 5% today. Their ticker symbol is VLD. However, the good thing is that analysts, professionals, and experts alike believe this company is undervalued right now, unlike the author of this article. They think that the company should be trading between $3 to $4 right now, and although that doesn't seem like a lot, jumping from $2 to $3, literally on a percentage basis, that is a huge increase. Going to $2 to $4 is a 100% increase, and going from $2 to $3 is a 50% increase. So this could absolutely be huge. However, let's talk about what the company actually does and what I think about it. Velo3d, like we said, is an additive manufacturing company that's focusing on enabling other companies to produce high-value metal parts. Essentially, they're trying to either create or sell a product that can create very complex internal geometries in regards to high-value metal parts. So that's why right now they are targeting mission-critical components for customers where there is a high cost of failure. So essentially, they want it to be one and done. These high-value metal parts also provide the company a large opportunity to where the market right now is worth around $100 billion. With the largest players in this market currently have a market share of around 10 to 5%, which is not that much, meaning that Velo3d can clearly take more market share. They do have a lot of competitive advantages, such as manufacturers are willing to pay a premium for their overall services, additive manufacturing enables shorter lead times, so it's quicker than mass manufacturing. Additive manufacturing is cost competitive, and additive manufacturing enables the production of complex parts that would be difficult to machine. So these are very impressive technological market advantages that Velo3d has, and they also have 3 main products, which would be Flow, Sapphire, and Assure, to where they all do something different, but they are highly regarded. And here's what I mean by that. They can literally produce things that would be close to impossible for traditional manufacturing methods to produce, therefore offering benefits like weight reduction, higher accuracy, improved performance, and a streamlined supply chain. And they've also worked with many large companies such as SpaceX, Lockheed Martin, Astra, Raytheon, Honeywell, Kratos, Mitsubishi, Honda, Lam, Stratasys, which is another additive manufacturing company, and many others. This is a very high-end list of companies that they are helping due to these companies being a customer of theirs. So overall, this is good news, but again, they do face strict competition in the additive manufacturing space from companies like General Electric, 3D Systems, and Desktop Metal. So this seems to be an additive manufacturing company that is somewhat under the radar, even though they do have really good products, and on top of that, they're rapidly scaling. For instance, their revenue more than doubled up to $27 million in the first quarter of 2023. The revenue guidance for the second quarter of 2023 is between $25 and $29 million, and for the full year, they're anticipated to bring in $100 to $130 million. And although, just like with UiPath, professionals believe that this overall guidance is going to decelerate over the long term, in the short term, this company looks very good to have. Now, here's where the author of this article comes in, saying that based on the revenue multiple of this company, Velo stock looks quite expensive, so people are going to be paying a premium by investing in this overall company. However, I completely reject that. If they're bringing in around $120 million a year, with their market cap only being around $380 million a year, that's not a bad PS ratio, especially in regards to their rapid revenue growth. Now, they do have a rather high short interest of around 12.81%, but again, this company is going to be very volatile. So all the companies we've talked about today are very volatile, very high risk. I'm not saying to buy or sell any of these companies. I just want to make sure that you're aware of them. So I would love to hear your thoughts down below. Remember to go and annihilate that like button, comment your thoughts down below, subscribe if you are new, and I'll see you in the next YT video.